anytime you have receivables, you run the risk of having some of those to be uncollectible. So we need to know how to account for those. What happens if you have uncollectible accounts, or when you need to talk about writing off receivables? We've got two methods to choose from: direct write-off method or the allowance method. They're a little different in how we record things and when we record items. Direct write-off is pretty straightforward. What we do here is we wait until we specifically identify an account that will be uncollectible. When we know a specific account is not going to be collected, then we write it off. And that's all we do with the direct write-off method. Okay, so let's say that you saw or you had a notice sent to you that one of your customers has declared bankruptcy, and you'll be receiving no money for their account. You can pretty much say that that's going to be an uncollectible account. So you can write that off. If you are operating under the direct write-off method, then the entry that you're going to make would look something like this. Get some ink. You're going to have an account called bad debt expense. And let's say that that account was for $3,000. Okay. And then that shows the part that was bad debt. We increase that expense account with a debit of $3,000. The other side is that I don't want to show that they owe me the money anymore, because they're not going to pay. So I don't need to keep that in our receivable. So we want to decrease accounts receivable by the $3,000. So we credit that account for $3,000. Now we have written off the account. It no longer shows on our records, and we show that instead of getting cash for it, we had a bad debt. We have an expense for that because we're not going to collect on that account. That's the direct write-off method. Okay? It's all you do. Wait until you find one that is uncollectible and you write it off. If you're going to do the allowance method, however, well, I tell you what, before we do the allowance method, let me give you another circumstance. Okay, so you got that notice, it's bankruptcy, we've written the account off, and let's say it's next year, 2 years even, and that individual suddenly has sent you $3,000. Let's say that they've come out of bankruptcy and they really felt bad about those that didn't get the money that they were owed. So they've paid back all of those old debts. Well, you've written it off already. It doesn't show that they owe anything at all. So what you need to do is you're going to have to reestablish their account, and then you can accept payment for it. So again, under the direct write-off method, the first thing you need to do, draw a line. So this is where you have recovery of an uncollectible account. So the first thing I need to do, because right now I don't show they owe me anything, I need to put a receivable back on the books to show that they owed me money. So we put that accounts receivable back. And now I also need to take away the bad debt, because it's no longer a bad debt, because they're actually going to pay me for it. So I need to credit bad debt expense for $3,000. It's kind of like a reversal or a reversing entry of what we did to begin with. So now I've got the receivable on the books. So I show that they owe me money now. So now I can record receipt of the payment. So I got cash, $3,000, so we increase that asset account with a debit. And now they don't owe me the money anymore, so I'm going to decrease accounts receivable with a credit. It seems a little silly, but it's good for an audit trail and to show us exactly what we've done and why we've done it. So the first thing you need to do is reinstate the account, and then the second thing we can do is accept the cash and take the account off, so they don't owe us any money. Now, allowance account, or the allowance method, is different. Okay, that was direct write-off. Under the allowance method, what is going to happen is each year we're going to make up an allowance for what we think will be uncollectible. And there are several ways we're going to do this. We'll talk about that in a separate lecture, but right now let's assume that however method we've used to come up with a number, we think that we're going to have, say, $22,000 that we estimate will be uncollectible, or that we need to adjust an account for. We're actually going to make an allowance for what we think will be uncollectible. So we're going to have an account called allowance for, and I'm going to run out of room. Hang on, I'm going to write the name of this and then we'll talk about it. Allowance for doubtful accounts is one thing that you'll see it called. Sometimes you'll see it called allowance for bad debt. Sometimes you'll see it called allowance for uncollectible accounts. All the same thing. Okay, so any of those will do. So this is to make, again, an allowance for what we think is going to be uncollectible. And then we're going to use this allowance account to write off specific accounts that really do become uncollectible. So let's assume that in our previous example, that $3,000 that we determined was uncollectible. Okay, now we need to write it off. Well, to write it off, this time, we don't use bad debt expense because we've already set up an allowance account. And when we set it up, it would look like this. We've got that allowance for doubtful accounts. We'll shortcut it to save room. All right. And this account, let me erase for just a second. This account, let me talk about it first. Sorry, I left one thing out. Is actually an asset account. Specifically, it is a contra asset. What happens with the allowance account is I want to be able to take accounts receivable and subtract the balance in this allowance account to determine what I think we're really going to get in cash from those receivables. And that's what we call net realizable value. I'll shortcut it, but net realizable value. Sometimes you might see it called cash realizable value, but same thing. Okay? So on the balance sheet, you'll actually see both of these accounts. You'll see accounts receivable listed, and you'll also see the balance in the allowance account listed. You'll take the difference between those. Again, a contra asset, it operates in the opposite or a contrary way to an asset. So we increase those with credits, and they hold a credit balance. So when we go to set up this allowance account to begin with, this is what our entry would look like. We would debit or increase bad debt expense for, say, that $22,000 we talked about. And we would credit, which is also an increase, to the allowance for doubtful accounts for $22,000. That sets up the allowance account. So now it's sitting there waiting and ready for us to use when we find accounts that are uncollectible. Like that $3,000 before. If we were under direct write-off, we would never make this entry because we don't have an allowance account under direct write-off. The only thing we do there is wait until we specifically identify an account that's uncollectible, and then we write it off. If it's the allowance, though, you're going to set up this allowance account. Then you're going to use it to write off specific accounts that are uncollectible. So if we found that $3,000, okay, we got that notice again, they're bankrupt, not going to pay us, okay. Then what happens is we use the allowance account to write it off. So we're going to take allowance for doubtful accounts. I put 2 up here, I'm sorry. I should say allowance. Allowance for doubtful accounts, and we're going to decrease it or credit it for $3,000. We're going to use some of that allowance. And then we're going to credit or decrease the accounts receivable because, again, we don't want to show they owe us money because it's uncollectible. We need to take that off of our records. All right? And now let's assume the same thing before. What happens if they come back later and say, hey, we know we didn't pay you, we were bankrupt, but now we have the money, we really want to pay you? Well, right now I don't show they owe me any money. So again, the first thing we have to do is reinstate the account. So I need to put the receivable back on the books. Oh, sorry. Okay, there we go. So we need to increase or debit accounts receivable for $3,000. And we need to credit or put back into allowance for doubtful accounts that $3,000 that we had previously used. Then we can record the receipt of cash for $3,000 and now the decrease in accounts receivable. They no longer owe us that money of $3,000. Okay, this is the allowance method. Under the allowance method, the only time you see that bad debt expense is when you, again, initially set up or you adjust the allowance account right here. Under direct write-off, you use it each time you write off an account. But again, the only time we make an entry under direct write-off is when you find an account that specifically is uncollectible. When you do that under the allowance, that would be right here. You use the allowance account that you've already set up. That's the reason you set it up, is when you find accounts that are uncollectible, you take them out of that account.